Question is, well, the top 55% with all that spending power, is that enough to keep things moving at the expense of the bottom 45% struggling?
Mr. Downs.
What's happening?
Been too long, man. Great to see you.
You.
Thanks for joining us today.
No, I'm excited. Allied always makes it fun. So hopefully this isn't going to be a boring podcast like boring
of course
title.
It's not. You're on. But one of the things I'm really excited about is, over the years, you always have, I think, great videos, great emails where there's a lot of data that's always helping the consumers. And, you're one of the examples where sometimes you have long form video and I'll listen to the whole thing. So that's the thing. If you have,
You're that
Joe,
one viewer. I've been wondering who that was.
That was me.
No, I'm kidding.
But you think about even Joe Rogan, whether you like him or you don't, the guy has 3-hour videos and, millions of people listen to it. So I think of you when I think of interesting content, and the year is just starting, 2024. And we've also had a quick decrease in interest rates. And I hear the following question a lot. So number one, people that have bought in the past year and a half, who is available to actually do a refinance? Is it only people that bought the very peak? What were those numbers? And then number two would be, how have things changed over the last couple of months? So if you were buying last fall and now we're in January of 2024, how much of a difference is that? So why don't we start off with refinances? Like, who's available to refi now, or are we not there yet?
Yeah. So, it's interesting because in the mortgage business world, that's what we're talking about every day. And, what you find when you're trying to, let's say you're a loan officer and you're going through your whole pipeline of business, really, it's pretty easy. You're just going to sort by interest rate and maybe closing date and then credit score, loan to value, loan type, right? So that those are sort of the data sets that you're going to look at. And what we find, or what we have found, is there's probably only right now anyway, about 5 months in the last 18 where people that closed in that window are probably eligible to do something.
Mm-hmm.
But then the next question is, should you wait another couple months? Right. And that's always the problem with refinancing is like, okay, I'm eligible. It maybe makes a little bit of sense, but is it going to get better?
Yeah.
So then that leads to a different conversation of how much does that refinance cost? How fast until you recapture your closing costs and savings? But right now, it's actually not a massive window. I would say most every VA loan and FHA loan. So I think if there's anyone out there that has a VA or FHA or any real estate agent that has closed those in their book, they should probably reach out to those buyers and say, hey, you might actually be eligible for refinance. Part of that is because when markets rebalance, we went from a very unhealthy trading environment, meaning Wall Street mortgage bonds trading, to a somewhat healthy and better rate climate. And, you could see an FHA rate that was easily 7% could now be 5.5 or 5.75. And FHA VA, they have an instant ability to refinance almost no matter what. Like, they don't care what your credit score is.
Yeah.
You just have to make 6 or 7 payments and you're good. Now, the closing costs, of course, are another big piece to talk about. But I would say the bulk of the people are those people. And then really anyone that has a rate over 6.75, 7-ish should at least engage in conversation.
Yeah.
But pricing loans is tricky. And a lot of home buyers, and you've probably seen this yourself just in Allied's book, it's kind of been the tale of two extremes. There's been the super high end was really strong in the last 12 to 18 months, but those jumbo rates that those people were getting were actually still pretty good. And then a lot of first-time home buyers, and first-time home buyer rates were subsidized over the last year. Meaning if you saw an average rate of 7.5, well, the first-time home buyer was probably getting a rate of 7 or 6.75. Yeah. So, there's a lot of moving pieces to this refi story.
Yeah. And so for the people out there who are listening in, consumers, tell us the difference. VA, FHA, conventional. Tell us the difference of what those loans are and what the benefits of them are, like a VA loan, and how little you can put down, stuff like that.
Yeah, I mean, VA is awesome, right? So you try to come up with a product that rewards veterans for their service, and we work with a whole bunch of veterans. It's just a product of our local market, right? With all the bases and the Pentagon and defense contractors and everything else. But it's a no money down loan to infinity. You could buy a $5 million house and finance 100% of it. Interest rates are typically, when I say subsidized, there's an implicit guarantee to lenders that if the loan defaults, the government's there to backstop it. So because that bond has less risk, it trades better, meaning better interest rates. So usually it's someone that can put low money down or no money down, gets a better interest rate, does not pay mortgage insurance, and also is able to refinance no matter what in the future, as long as the rate drops 0.5% or more. So that's VA, but you have to serve in the military to have access to that product.
And
right?
so for
not
those kids in
everyone.
high school that are like, oh, should I go in the military? You might want to consider this.
Exactly. Yeah. You
Right.
get like free education and then, hooked up on a house.
There you go.
Right.
Exactly. And the no money down. I mean, when you're, just something to think about, whether you're putting down 5, 10, 20%, let's say $1 million home, right? 50, 100,000, $200,000 down. It's a lot of money to save. So what a massive benefit for people that have served, and well-deserved.
Yeah. Yeah, no doubt. It's interesting. So I live in Annapolis, a big Navy town, but a lot of people, retired military, seem to flock here. My neighborhood, I think I have a few admirals, a couple generals, and wherever I've lived my whole life, it's been that way. Just like high-ranking military people. And when I find the career military, and obviously they kind of move around a lot, right? Every 3-4 years you're going somewhere, and the people that wound up buying property at most every location that they went to, here they are now 30-40 years later in retirement years, living off of $20,000 a month cash flow.
Yep.
And, for the most part, had the ability of doing some of those things using a VA loan without a lot of money down and always refinancing no matter what. So it really is a kind of an awesome long-term way of looking at life.
Yeah. And I mean, you think about too, healthcare is included, right? For people in the military, that's a massive expense once you start having a family. So, I mean, there are some true amazing benefits of serving, and even from a financial side, even. All right, cool. Well, jumping into FHA, give us the FHA meaning behind that. And what does that look like?
Yeah, so FHA would be another government guaranteed mortgage. And it's designed for, if I say what it's used for versus what it's designed for, it's designed for people with low down payments to buy a house, a little bit more forgiving underwriting guidebook, right? So you can have a little bit more debt than a conventional loan. Your credit score can be a little bit lower than a conventional loan. But what I would say is it's used mostly more on a credit challenged kind of buyer or a really big sale price with low down payment. We're fortunate in the DC metro area to have expanded loan limits where you could put 5% down and get a conventional loan on a home price of like 1.2. So, a lot of people used to leverage FHA for that, but now really we're putting more and more people in conventional loans. FHA though, as they lose market share, they start making tweaks to their process, and they just reduced their monthly mortgage insurance not that long ago by 0.5% roughly. And by doing that, they wound up just making that product so much more appealing to higher credit score buyers. So I think you're probably going to see a lot more FHA and the real estate community will over the years ahead. But same thing, it's a guaranteed refinance. The interest rate's going to be a lot better than a conventional loan. Your credit score does not really matter at all, meaning as far as how your pricing goes.
Yeah.
And then when you bridge into conventional loans, that's really where every little bit that you put down matters. The property type that you're buying matters. Your credit score, every 20 points that you're less than 780, your interest rate can change. And then your mortgage insurance changes with those same buckets, and is different whether you have one person on the loan or two. So it gets more complicated. And that's honestly what makes the refinance story right now much more tricky.
Yeah.
Is because you're, as lenders in the old days, we'd look at it and call you and say, hey, you've got a 7% rate. Rates today are now 6.25. Let me send you a quote. Now it's, hey, rates can be anywhere from 6.25 to 6.75. You may or may not qualify or make sense to refinance. We should talk.
Yeah.
Because of all those pricing adjustments that are now there.
Yeah. And so FHA, Federal Housing Administration, right? Not authority. I always get that mixed up. So who qualifies for that Anyone can qualify?
Yeah, anyone. There are restrictions to how many FHA loans you can have. Probably easier to say you can only have one. There are exclusions, but really, it's anyone at any income level that wants to buy a property that currently doesn't have an FHA loan. That's the easiest way to sum it up.
Gotcha. And typically, if you had to compare apples to apples, conventional versus FHA, I mean, would FHA typically be a little bit lower, or it just depends?
It really just depends. So if
Yeah.
you're a first-time home buyer and you make Fannie Mae and Freddie Mac FHFA, they kind of hook up any first-time home buyer that makes less than 120% in our area of median income. So for us, that's $180,000. And if you go ahead and you're a first-time home buyer and you take a conventional loan in that price point, then your credit score doesn't matter as much, and conventional is always going to be better.
Okay. Gotcha.
But
It's good to
then
know.
if you're a move-up buyer, so you're buying your second home, or you make more than $180,000, FHA might make more sense. Really, all depending on what your credit score is.
Yep.
So it's really like you have to look at everything to figure it out.
It was really interesting when you were talking about the amounts you need to make or can't make to qualify, right? And so under 180,000, you qualify for an FHA or a conventional. What did you say there?
Yeah. So Fannie Mae and Freddie Mac, they basically said, and this is maybe about a year ago, it actually got a lot of press. It was when they came out and they kept trying to call it the Biden mortgage plan is penalizing people with good credit. Do you remember that story that was kind of
I
flying
do
around?
remember that. Yes.
Yeah. Well, really what they were doing is they were reclassifying the risk and the pricing of all loans. And in some buckets, it got more expensive. So for move-up buyers, people buying their second home, only putting 15% down, your rate might be 0.25% higher today than it was maybe 2 years ago. So they said, while we do this change, there's going to be people that aren't happy. We're going to subsidize first-time home buyers that make less than 120% of median income.
Okay.
So we're going to give this bucket better rates. And I kind of like the way they did that because, I mean, if we're being honest, housing has become a luxury product. And I think it has mostly, at least in the last few years, rewarded people who already have assets. And it's really, really, really hard for the first-time home buyer to get in. So if we charge move-up buyers a little bit more money and make it just proper risk and in a backwards way subsidize first-time home buyers, I'm kind of for that.
Yeah.
But it does make quoting rates more complicated because there are also loopholes to how to kind of work around the income. I've had people make $300,000 a year, and we find ways of still sliding them into that $180,000 bucket where they get better rates. And it actually makes people look at sort of a menu of options. You know, here's FHA, here's if we can get you under that first-time homebuyer program. Here's what it looks like if you're not. Here's if you buy the rate down or not. You know, there's the business has gotten much more complicated in the last 12 to 18 months than it has been in the last 20 some years I've been in it.
Yeah, you had mentioned, so you might not remember this, but we spoke about 4 years ago, and you told me this was before COVID, before interest rates went really low. You're like, I see interest rates going extremely low. You brought up some examples to me. I think it was Japan. It might have been some other things. You're like, after looking at these many data sets, this is why I think it's going to go low. And it did. It went extremely low. Now, did that happen because of COVID? Did it happen for other reasons? Was it a combination? The reason why I bring that up is, we talked about refinancing. Yeah, it might make sense to do it, but there is a lot of data showing that it's going to go lower, this year, right? The Fed has kind of tipped their hat that they're likely going to decrease the Federal Reserve rate. What are your thoughts related to that? And if you were in a situation where you might have bought at the peak last year, would you be kind of waiting around a little bit, or what are your thoughts?
Yeah. So, if anyone follows me on Instagram, I'm really active on my stories. So the stories are sort of my random thoughts. And that's where a lot of the data that you're referencing that I kind of push out there. And I don't know, a lot of people have mixed views on Elon Musk, but I've enjoyed Twitter a ton in the last year, getting a lot smarter, really talking to a lot of just economists and just different people in finance. The key for anyone out there that wants to get on Twitter, I do recommend starting over, like unfollow everybody and then just rebuild it. And the
Yeah.
experience is actually pretty fun. Um, but within all the data, I think data tells whatever story you want to tell. And that's the problem right now. So for instance, this morning, the jobs report came out and the headline was jobs, the jobs number beats expectations, up 200 some thousand, where expectations were like 150. Unemployment lower. But really within that, you had average hourly earnings a little up, average hours worked a little down, but then prior revisions from the last 2 months down a lot. So you could look at the headline number and the low unemployment rate and be like, oh my gosh, the economy's still roaring. The Fed's not going to drop rates.
Yep.
Or you could look at the revisions and the fact that people are working fewer hours. Those are metrics of things slowing down and exactly what will make the Fed drop rates. So I think everything always has two sides of the story right now.
Yep.
And that's what makes it so hard. So my feeling with refinancing is always, if it's near free or you can recoup your cost in 6 months, you should probably do it when it makes sense. When there's a lot of volatility and funny things going on with the data. Like this morning, like if I had a data report that told two different stories, depending on which two pieces I used, that is market confusion. I don't think anyone can have conviction with that.
Yeah.
So if you can save money and you can, when I say recoup your costs, let's say it's $4,000 to refinance. And you don't take a lender credit where the lender pays it for you. You write a check for $4,000.
Mm-hmm.
Well, if you can save 1% on a $700,000 loan, that's $7,000 a year of interest. So you're recouping your $4,000 in like 7 payments.
Yep.
So that's like okay, do it. If rates go lower, great, do it again.
Yeah.
But what if they don't? That thing that came out over the last few weeks, that shipping route, was it the Red Sea or something? It kind of goes from like India up through Egypt maybe, and then over the Atlantic. And that's kind of like a shipping route.
Yeah.
But now because of whatever's going on there, and ships are just like, I'm not going there because we might get hijacked or shot or whatever. So now they're going around the tip of Africa. And shipping container rates doubled in the last week. Well, that's inflationary if that continues. So there's so much weird stuff that you've got to like,
and those are those little nuggets that we want to thank you for right there. No one would know about the shipping container double prices. Amazing. Thank you.
Yeah, but someone said like, why does it even matter? Like, why?
That's why it matters, right? Because you double the price of shipping, that hits the end consumer. Yeah, it's really interesting. Yeah, I love that. What, by the way, following you on Instagram, just so people can do that. We'll pop up your thing on the screen here, but how do people follow you? What's the name of your page?
So it's Top Mortgage Lender, which is funny because I was just messing around one day and I was like, oh my God, Top Mortgage Lender is available. So that's my Instagram. Advisor John over on Twitter.
I saw that on Instagram recently and I'm like, how did he get that? Did he pay for that? That was available?
That was available. Yeah, it was available. And I was like, well, why not have a little bit of ego in the handle name?
I mean, that's a no-brainer. I love it.
Yeah, but to your point, just to put a button on it, like the when you should do something, and the one comment you made, which was it's pretty convincing that the Fed's going to drop rates and that rates should go meaningfully lower. And like that statement, while I believe it, I also enjoy talking about why that actually might not happen.
Yeah.
Like, what are the things that might make that not go the way we want it to go? Mm-hmm. And I think that's what makes, when we advise clients or either help realtors just kind of understand where things are going, whether it's for their personal expenses or to help guide their clients or invest in their business, is it really is sort of a what if. I think Goldman Sachs recently was the only analyst that came out. It's either Goldman Sachs or Morgan Stanley, and they gave 3 different outcomes for the year. They're like, it's too early in the year to tell what's going to happen. But if this happens, this will happen. And then if this, and if this. And so I think that's kind of where we are.
Yeah.
I think 2024 could very well turn out to be a messy transaction year that looks very similar to 2023, which was not fun. I will say transaction count was probably down 50% as far as like actual sales.
Yep.
And if you strip out refinances on top of that, it just makes all the ancillary industries that are surrounded by real estate difficult. So I think 2024 could be a lot like that still. Or it could just be this flood of buyers that get in if all of a sudden interest rates completely unwind.
Hmm.
It depends why they unwind, but
It really
it could
can
be interesting.
go anyway. I mean, let's be honest. In 2022, everyone's saying, "Oh, interest rates will be down in 23." And look, I mean, I feel like a lot of people say that just for their own mental health, just to have hope. I don't, but it's interesting, right? Because we're hearing the exact same thing. But let's just say, like you said, we're adding a lot more jobs, and all of a sudden the Fed's like, huh, it's actually really healthy. We're not going to lower it at all. And so, and then we see inflation, right? And so, no, it's a really good point. We like to always say, we're preparing for interest rates to be high for years to come because we have to, right? But I've also was talking to someone recently. What happens a lot based on historical data is that something crazy happens in the world, and all of a sudden you'll see a really fast drop. But that might not happen for a couple of years, whether it's a war, whether it's another virus, whether it's something crazy, right?
Mhm.
That can just happen out of nowhere and completely change things. And that's something that I feel like data analysts never estimate or guess, right?
Yeah. Yeah, so 2018 may have been when you and I had that last conversation. So
Hmm.
rates were peaking. The Fed had been raising rates for about 3-4 years. And then 2019 was the year it all reversed. So this was pre-COVID, but
Yep.
interest rates still went from 5.25 to 3.5 that year. And what we found is it was just this natural, they call it the lag effects of Fed tightening.
Hmm.
So as they start raising rates, it doesn't just slam and slap everyone across the face, other than people in real estate mortgage, right away,
Hmm.
because businesses have a little bit of cash. They spend their cash, and
Yep.
consumers, they're a little slow to react. Those credit card bills don't hit them as often. The high interest rates for cars. When businesses start running out a little bit of money because consumers are pulling back, they go to raise money or get lines of credit. If credit is tighter or more expensive, they can't get their loans. They stop reinvesting in their business. They hire fewer people. They lay off people, right? It's this whole long stretched out process. In 2019, we finally felt the tightening of 17, 18
Yep.
hit the economy in 19. And that's why interest rates went way down. Now, a lot of people have said that same thing should happen this time around, but then there's always that, yeah, that phrase people say, but this time it's different.
Yep.
And there's so many things that are different about this time. One is, if 60% of the people out there own a house, and let's say 5% of those people bought last year, so we'll take them out, 55% of the people, they now have mortgage payments about $1,000 less than they were a few years ago because they refinanced. And they're all making a lot more money. Like, everyone fails to really recognize the strength of how much wage growth we've experienced.
Yep.
Like, I can't talk to someone without them making 100,000 a year anymore. It's crazy. Like,
Yeah.
before, I would always have, if there's two people in a household, one person made 70 and one may have made 120. And now, like, everyone makes 100 grand.
Right.
And right, it's not everybody. And
Yeah. Of
obviously I'm
course.
talking with homeowners, which are, the people that are a little bit higher income anyway, naturally.
Yep.
But you have 55% of the people out there sitting really, really, really good and spending very, very, very freely.
Hmm.
And then people on the lower end who do not have a lot of assets, that's where the pain is. And the question is, well, the top 55% with all that spending power, is that enough to keep things moving at the
Hmm.
expense of the bottom 45% struggling? And I think that'll be the story of the next couple of years is the Fed tightening really, really finally going to hurt things? And are we going to see the brakes hit on the economy and the Fed totally reverse course like they did in 19, and interest rates get really good? And in that year, keep in mind, interest rates were falling almost the entire year. And real estate didn't really spark until June
Yeah.
because it was a little bit of confusion, a little bit of overhang of high rates. Google searches for buy a home were way down. Like, it was out. No one wanted to buy a house. It's like, oh, you're an idiot. Rates are high. And oh, I think prices are going to crash. That was the story of late 18, early 19.
Yep.
And then eventually it was, oh, the economy is slowing down, but not here. Right. So DC and surrounding areas.
Yep.
And if anything, our market is 10 times more diverse than it used to be as far as the types of jobs that are here, that I think can withstand any slowdown that we have nationally. So anyway, you put all that together, I think there's a good chance that we play out to be just like 2019.
Yep.
And
No,
maybe the spring we Go
It's
ahead.
a really good point. I remember into 2018 very clearly because I was listing a house flip I was doing in Capitol Hill, and rates went over 5, and it was like hit the brakes, you know.
Yeah.
And so like people were like, "Oh, I'm not buying over 5," and it really is all about perspective, right? So now we have people, rates went over 8 at the end of last year, and the news is if we ever get to 5-ish again, oh my God, the housing market's going to explode. So it's
Mhm.
funny how perspective always does change, right? And what I've noticed is when rates were increasing from 6 to 7 plus, people are like, nope, no one will ever purchase. And people get used to it, and they do. And even though, yes, volume is down significantly, there's still transactions out there. And so
Mhm.
it's interesting to see it all play out. And I think you're really right about the whole thing about no one really has any clue. I mean, yeah, if everything acted exactly as if there weren't major things that happened in the world, then you might have some kind of idea. But even in that scenario, too, you get a report like happened today. Oh, big job increase. That was unexpected. And this, we're going to tighten things up
Yeah.
again. I
Yeah, a
love it.
lot of different things. I mean, in the end, when I counsel people and we're trying to figure out whether they should buy or when they should buy, I always say, let's try to forecast life a little bit and let's see how this plays out. So you make this decision today, and then this happens, and you're 3 years from now. What do you think? And when I talk like that, it's like, you're getting married and you want to buy a place where you're going to have a kid. Well, if you have a kid, it's like $2,500 a month childcare. So, one, do you want to live there with a kid that age? Two, if you have that extra expense, you're gonna be able to afford it. Should you buy something smaller or bigger? Should you move out, get prepared for better schools right now or not? So it's the same thing goes when you kind of think of economic stuff. There are things you control, which is your life,
Yeah.
and hopefully with your employer and your job, and you have a certain level of stability and confidence there. And then there's all the stuff you can't control. And then how does that impact the decision that you make today? And the further we stretch life out, generally, it smooths out every bad decision, especially when real estate's involved.
Yep.
Right? Like you buy, I know there's going to be some people that bought a house in 2023 and they put 3% down, and they're not going to be able to refinance without bringing money to the table. Like it's going to exist out there for sure. But so did they make the right buy decision though? When they bought the house, can they afford it? Was it the right move? And the reason they might have to bring money is maybe prices pull back just a teeny tiny bit. Maybe their credit score dropped just enough where they have to do an FHA over a conventional, or there's a lot of different ways of kind of peeling it back.
Yeah. Earlier, you mentioned a no cost loan. Just for the audience out there that's thinking about refinancing, or what exactly does that mean, and how you can tweak the interest rate to maybe potentially get a credit. Um, can you give me
Yeah, so essentially it's building the closing cost into the interest rate.
that?
So let's say the best rate out there is 6%. And then all the standard fees for refinancing, again, we'll say is $4,000. Um, and a mortgage company might say, well, if we give you a rate of 6.25,
Hmm.
we will pay all $4,000 of those closing costs. So essentially, you buyer, you can lower your rate to 6.25 and it's free, or you can lower it to 6 and it's going to cost you $4,000.
Yep.
So that conversation is, okay, well, what is the break even between 6 and 6.25? So if it's
Yep.
a 0.25% on a $600,000 loan, it's $1,500 a year of interest. I have to keep that loan for about 2.5 years. The 6% loan to equal the cost of the 6.25.
Yep.
Right. So if I bought $4,000 down to get 6%, 2.5 years in, those loans are identical. So then the question is, do I think I'm going to refinance before 2.5 years? And if the answer is yes, take the 6.25. And the other thing, and you might actually see this as you're doing closings, but anything that is a financial product is attacked from a sales angle. So it is a highly sales focused industry, unfortunately. And it's like most every financial product out there. You're being sold a something, like you called or clicked because of what? Like, oh, that rate looks low, right? Oh, I can save $500 a month on my mortgage. My servicer sent me this thing that says all I have to do is refinance and I can get 20 grand and save $50 a month on my payment. So all those things you're being sold. There are a lot of refinance estimates I'm seeing right now that are teasing a rate that begins with a 5. But when I look at the estimate, it's like $20,000 of closing costs.
Yep.
So I do believe if anyone out there is refinancing, like there's interest rate and then there's cost.
Yep.
And they really, really, really need to understand both
Yeah. And
because they're directly connected.
when you're hearing 20,000 of closing cost, is that always paid up front, or is there a way that closing cost is rolled into the loan and you don't realize?
So there's the sell, right? So I've seen some estimates or emails, not estimates, because estimates, there's like federal regulation, like you get a certain estimate.
Yeah.
You can kind of look at it and tell, but people generally will focus on how much cash do I need to bring to the table. So with no cash due at closing, I can give you a rate of 5.5% with this payment. But because it's zero cash at closing, it's because I'm increasing your loan amount by 25,000.
Yeah.
Right. But they don't say that part. So
Sure.
it is. So yes, you can roll all those costs into your loan. But I would say it's probably not a great move. I mean, it is for some. There are so many situations with people. Like I have someone right now that they bought a house in 2018. They were forced to do a really ugly refinance in 2022. So super high interest rate. They're trying to help family out and had to pull some money out. Well, now they're refinancing right now because they're planning on moving at some point in the future. They don't know exactly when, but they know they're not going to be in this house forever. So they're just going to do the refinance now to lock everything in because the future from here is unpredictable, but they know they're keeping the house.
Yep.
So that person might pay a little extra to refinance because once you move out of the house, refinancing gets more expensive because it's an investment property. So it's like case by case, everyone's going to be a little bit different as to whether or not they should pay fees, roll fees in, pay it up front. It's kind of like we're all unicorns.
Yeah. And for those that don't know, so if it's a principal residence, you're typically going to get a better rate. It's going to be less expensive than if it's an investment property. It's kind of where you're going with that. Once they move out, That makes a lot of sense. So yeah, you talked about, people might receive something in the mail and, you want to, I know you've brought up a lot of times like financial literacy, and also for your clients, you're kind of helping them from a financial standpoint over multiple decisions in their life, not just, a home loan or a refinance, right? So tell me how you do that typically when you're working with clients. Do you have clients that reach out to you non-related to, home purchases and get your investment advice? And that's not something I hear about, often when I hear about, a mortgage lender.
Yeah. So it is funny. I get a lot of people that are like, so do you manage money also? Like, can you help me invest? So, no, I can't. I will say there is a designation that I have, a certified mortgage advisor. And essentially what it is, it's a training where I could be a financial advisor, but I'm not licensed to do so. I could do your taxes. I'm not licensed to do that either, but I happen to do mortgage. But the reason that designation exists is because I believe everything in mortgage impacts all those other things, right? So if you're going to put money down on a house, well, there's a financial piece to that. There's opportunity cost of that money. There could be tax implications of where it's coming from. And then you have to weigh, does it make sense to put less down or not, depending on what else that other money might be doing, right? So there's a lot that goes into it. Then there's the tax piece if you do certain things. And so anyway, so that is, yes, I get that a lot. But I will say that it's one thing to invest. I'm too emotional probably in markets. You probably see that if you follow me, right? I like the, wow, look at this. I wonder what that means. And a lot of people with investing, they see something and want to act on it right away. But that's usually where a lot of the mistakes are made. Fast action without really thinking through it, right? Like that jobs report that we talked about this morning. That's the same as companies coming out with earnings reports. You'll see stocks shoot up when the earnings report comes out. And then they have about an hour later, they'll do the conference call. And there's like two things the CEO said that makes the stock tank because it's forward looking, right? So there's so much to go into it, right? I think people need to deal with people that are experts in that one space. Financial advisors, they are experts in analyzing all of that stuff over long periods of time. And like my experience in life and business, so 25 years in the mortgage business, is lots and lots of people that bought houses and did certain things and had different outcomes. And I can use thousands of family stories to counsel individuals, right? I've had some do this and this happened. I've had some like you do this and this happened, but like real stories. Financial advisors have that access at a much different scale, right? They probably deal with way more people than I do. And then they have 40 years experience showing how things unfold and work.
Yeah, no, I
So
like that. And yeah, so I'm a part of a young professionals organization. It's business owners across the
you're not too old
world.
for that?
No,
They
it's
kicked me out of mine. They
shockingly,
were like,
I
sorry, John,
snuck,
you're in your 40s.
I snuck in this year. Max age is 45. So I mean, look,
Nice. All
I
right.
had to
Fair
do
enough.
it this year. But there's one thing they point out a lot, which is called experience shares. And experience shares are not telling you what to do with your money, but it's providing you real life examples of, hey, this person did this and this is what happened. This person did this. This was the negative result. This was the positive result. So you're not
Mhm.
actually telling someone what to do, but you're providing them data in a sense. You're providing them experiences and let them make their own decision.
Yeah. And that is the difference. When people are shopping for mortgage or their real estate agent, I think a lost skill is an understanding of what life experience, how that can actually change the path that you personally take. Meaning the people that guide you in life can often help you make better decisions. And in real estate and finance, the people guiding you are generally the loan officer and the real estate agent. And obviously other people in your life, your own financial advisor or your family, parents, whatever, friends. But a lot of times it's like, oh, I want to buy a house. My buddy that just got in the business a year ago is killing it. Hey, I'm gonna have him show me go buy a house. And that person's dealing with a loan officer he met that wanted to take him out like axe throwing or to a happy hour. And it's like, oh, I just met that guy. I think he's kind of cool. And that guy also has 2 years experience. And then you have this group of people going through trying to do this big, huge finance thing like it's not that big a deal.
Yeah.
and and first 10 years of my career, I was that person. I was hired. I was 22 years old. I knew nothing. And I was given a playbook. You go do this. I was calling on builders at the time. I had my scripts. I knew what to say. And once I got on all my builder accounts, the builders were like, your job is to convert people. They have an interest. You sell them on it. So that's kind of what I did for 10 years. And then financial crisis came, massive foreclosures, short sales. I lived so many personal disaster stories of people because they would call me, John, my neighbor just foreclosed on their house. I owe 900. They just sold it for 500. 3 more of my neighbors haven't made payments for 6 months. They're going to let the same thing happen. What do I do?
Yeah.
Right. And then that would lead to families moving, divorces because of financial stress, kids getting into bad school districts, getting into trouble and gangs and like whatever. Like I lived so many of those stories that I think now I give much better perspective of life. And I feel like people that come in and deal with the experienced people in the industry, I just think they get a different perspective. And I think they learn things that they're going to use for the rest of their life.
Sure.
And I'm not saying that younger people in the business can't have the same ideology, because you can learn it, you can study it. Like I teach it a lot for new people in our company, and always have. And a lot of the people will use my stories. Well, John said, he had this person that did this and this and this, because I want to make them better in their careers and their life too. And a lot of real estate agents will use sort of the same thing. So I'm not saying agent experience is like, you need it.
It matters. It matters. Let's be honest, and yes, you can go and educate yourself and learn, but there's nothing like a punch in the face, right? There's nothing like the actual experience to actually be like, wow, that really, truly hurt. And I don't want to ever go through that again. Right.
Yeah. And part of that was me, right? I didn't want, those calls were awful, awful. Now, was it my fault? I would say no. If it wasn't, back then people were seeking something and they were going to find someone that was going to do it. And all lenders had kind of the same products. And it's like, well, yeah, you could. And it kind of looks like this, like, hey, let's go buy a house. But because it was so painful for me to deal with all those things, I often wondered if I at least asked 1 or 2 more questions, would people have made different decisions? Now, the financial crisis was different. I think everyone was screwed in that area, like mass area. There was just property prices went down so much. But like, fortunately, I'm at the point in my career now where I don't have to worry about my referral partner getting rid of me. Like in the builder communities, it was like, oh my God, if I don't find a way to make this loan work, they're going to kick
Yeah,
me off this list. And this
sure.
account is a $20 million a year account to me. I can't lose it. I got to make sure all these loans close. Well, you get a little older and now you're kind of more financially sound. You don't really care about one specific deal. You just want to give really good advice all the time.
Yeah.
You know, that person also gives much better advice. And I've always said that at least of the real estate agents that I work with, when I find real estate agents that don't need that sale, the advice they give their people is generally very different. I will hear more and more like, no, they should not buy that house. Or no, that they decided to rent for another year. I think it was a good move for them. And I have countless um, calls every now and then over the last year where someone says, a real estate agent will say, John, please do whatever you can to convince these people to buy a house. I haven't had a sale in 4 months.
Yeah.
I mean, like, who do you want to get advice from if you're buying a house? Like,
Sure.
you don't want that person. You would hope to have the person with experience and financial backing that the only thing that comes out of their mouth is good advice.
Absolutely.
And again, I think that's the part that if there's one thing that people take away from this whole podcast is probably experience matters. And you want to deal with someone that doesn't need your sale. You know, they want to work with you for the next 30 years, not the next 3 months.
Yep. Yeah, it's the desperation is a real thing, especially in the market we're experiencing right now. Very, very tough 2023, 50% drop in transactional volume.
But then we have to kind of look back and say how much of 2020 through 2022 was real.
Yep.
Versus how much of that was pulled forward demand of 5 years, right? Like we could truly be in a completely different paradigm moving forward,
Yeah,
where transaction volume stays low for a while.
See, that's a really good point. So when we were trying, it's funny because we were growing very fast. Inc. 5000, fastest growing title company, no bigs. But actually, it's number 2, number 1, organic, whatever. But the point is, when we're growing like this, I remember in like investor discussions, it's like, all right, well, then if we're growing at 60% this year, we'll grow at 60% next year. In a couple of years, we'll be like that. It's like, are we even in a real environment, right? And so now with a 50% decrease in volume, what is the actual normalized volume that we can expect moving forward, right? You have these people locked in 2.5 to 3.5% loans. Will they, well, 90% of them just never sell that house. I mean, and I'd love to get your thoughts on that. And, have you determined, is last year, which was a very painful year, is that normalized volume or is it 25, 50% up from that? I'd love to
I
hear
hope not.
Exactly. Right. And if so, there's not going to be many people in the industry, right?
Yeah. So, and that is probably the reality is there's a lot of, the cleansing, I think both mortgage and real estate, if you do 20 transactions in mortgage per year and 5 to 10 in real estate, you can do pretty good. Like, I mean, it's like good enough, right? You can survive. But the problem is when markets shift, the people that do 10 a year go to 1 or 2.
Yep.
The people that do 50 might go to 25, right? Because it's just a bigger base. And I think when things get more challenging, natural behavior is to go to the more experienced.
Mm-hmm.
And then I also think more experienced, they sound a little bit more confident. So their pitches are a little bit stronger, where desperation of the others kind of shows, and it's like a downward spiral for them. So part of it might be just fewer industry participants in general. But a lot of people were saying that when rates drop, that we should see a pick up in inventory. And while I think there's a chance of that around the country, I actually think in our market, lower rates will bring more move-up buyers.
Mm-hmm.
But a big percentage of those move-up buyers, I think, will keep their house as a rental. And that will probably put even more stress on inventory. Meaning
I agree with you. I agree with you because, let's just say rates get to 5.5 or 5. You still have a house at a 3% rate. Why are you selling that? Aren't you just renting that out if you're going to move up? And so, yeah, I'm in agreement with you. So the concept, I guess, would be because rates lower, those people are selling their 3%. They're selling their homes where they have a 3% rate on it. Is that the concept?
Well, so yes, meaning why people think inventory
Why
would go
people
up.
think inventory will go up? Yeah.
Yeah. Yeah. Now, the other reason they think inventory might go up, though, is if rates come down due to economic stress, they feel that investors, especially the ones with Airbnb, that they might actually be under stress to sell. For instance, in Austin, Texas, there's like a bazillion short-term rentals. And that was a huge investor population.
Hmm.
And coincidentally, they're down 20% home value year over year. So that's an example of investor centric
Yep.
having inventory struggles and price struggles. Because of the DC short term rental laws, I think we really skirted the deep investor mix, right? Like
Yeah.
institutional buyers, and people are like, oh, I need to go out and just buy as many properties as I can to be a super landlord. That didn't really exist in DC Metro much. So I think it's out there, but it's not nearly as prevalent. So when interest rates drop, that brings in more move up buyers, right? Just because they can afford it. They can now look at it and rationalize like, it's not that much worse. And we've been stuck in this house for a little while longer. Our family's a little bit bigger. We're making more money, right? They want a bigger house. Now, the old cycle was sell house, buy new house. But I think as people move up, there's going to be maybe a 25 to 30% of the sellers that say, man, I don't know, rents are still pretty high. I can rent it for $5,000. My payment's only $3,000. And maybe I could use that cash flow to buy an even bigger house. I don't know. I'm going to keep that old mortgage.
Yep.
So then will inventory actually get worse? So
Yep.
it feels that way. I think from the conversations, I did a poll of past clients. It was about 800 and some people. They got a 30 to, what was it, 50% response rate. 30% of the people got a little bit deeper with me. And it was sort of just like, what rate do you want to move? When do you think you want to move? What's holding you back from moving? And when you really distill it all the way down, it was like a 5 to 5.5% rate unlocked a whole bunch of people.
Hmm.
But then all those people, we would say, so are you planning on keeping your house as a rental or not? Like, is
Yeah.
that part of your philosophy? And it was shocking how many people said yes.
Yeah.
And part of that, I think, is, social media has financialized housing so much. Like, you can't turn on Instagram and not see like the real estate bros like, oh, get rich and own 20 properties by the time you're 30.
Yeah.
It's the way to wealth and independence, and quit your day job. So like, it's now ingrained in everyone's head: buy a house, keep it forever, house hack, rent, cash flow.
Yep.
So
Yep.
if that continues, inventory gets worse as people move up.
Yeah, no, it's yeah, I was just listening to, a famous podcaster this week, and he was basically like, I lost millions of dollars in doing house flips the last couple of years, and I did pay back all my investors, but that's because I brought millions to the table to do so. And so, when you hear those great stories, things are so good, you get it's when it feels so frothy, it always crashes from my experience over the many years, whether it's the internet bubble, whether it's the 2007, 2008 before the financial crisis, whether it's the crypto market. When it becomes too good to be true, I'm yet to see that continue on. However,
Yeah.
I've made bad decisions on all three of those. So here we go. Let's go.
Yeah, but the good thing is, a lot of the greed of this cycle, I just didn't see it locally. Like, that's what's
Yeah.
so cool. So for like local home buyers, if you believe the story that inventory is going to remain tight, which I do believe. If you believe low rates will bring in more move up buyers, I believe that too. I also believe more of them keep their departing residents. I think inventory does get a little bit worse. I think if inventory stays low, value stays supportive. If your local economy stays strong, that brings in more people that are able to purchase. That keeps demand high, right? The supply demand imbalance still
Hmm.
stays skewed. And that story of buying locally still remains strong. I mean, if I was in
Agreed.
parts of Florida, parts of Texas, if I was in a Zoom town, where all the work remote people were able to go and enjoy like outdoor lifestyles, I don't know if I would want to buy there, because I do believe work from home kind of unwinds from here quite a bit. And we're already starting to see that.
Yeah, and I think you're really right too on the whole Airbnb model, right? So, hey, I'm going to go buy this house. I've locked it in at a 3.5% rate. I'm renting it out for this much. When all of a sudden, oh shoot, my 3-year, 4-year arm is up, and now I've doubled my payments on this thing. Not many people are doing Airbnb. In fact, a lot of local towns, are putting restrictions on it. there's some inventory there that will open up, like kind of like you were saying.
Mhm.
But I agree with you. It's really not, that's not in this DMV market, right?
Yeah.
And so, the DMV market is going to be, it should be really strong, but you can see how those certain pockets are going to be, those housing prices, a 20% drop. That's a very painful experience. I had a friend in outside of in Illinois, outside of Chicago, and it was this small little area, and it was really popular. And it was something like something happened where like a big business there that was propping up like a lot of the people there left. And this guy tried to sell his house for 3 to 4 years,
Mm.
eventually just stopped making payments, bought it for 850,000, had to sell it 4 years later for like $400,000. Like that is a just disaster to someone's
Mhm.
financial, life and history. And it's sad that that can happen. A lot of people just don't think about that and how that can happen. Luckily in this area, it's just very, very unlikely, you're having one business propping up an entire little area, right?
Yeah.
And it's unlikely, I would say, to probably happen.
I mean, if there is stress in our market, I would say did you notice an uptick of second homes in the mountains?
Yes.
So like Blue Ridge Mountain,
Yep.
Shenandoah, so like a lot of the people that I had that bought out there, their rationale was always, I can enjoy it. When I'm not enjoying it, I can Airbnb it. And look at these Airbnbs, how much they're getting per night.
Yep.
Well, when everything you're comparing to is a work from home world with extreme freedoms that we've never had in life at mass scale in employment,
Yep.
and then you send all those people there, of course it's going to be, right? The demand is so high. But now that everyone's flying and going to restaurants and being closer to work, you could see that pulling way back. So, maybe the stress of our market is the mountain weekend home, but not the everyday single family condo, within commuting distance of DC.
It's a really good point. It's like, how many times, are you with people like, hey, I need a house in Lake Anna or the mountains? Or it really has been a very prevalent conversation over the last couple of years. And a lot of people made those investments. And so that's a really good point, kind of
Yeah,
how
and
that
prices
ties in.
doubled. Prices are quadrupled. There was, what I saw that it was a 150. It sold back in 2016. It sold for like 425 or
Yeah.
something. But based on Airbnb revenue of like 4 grand a month,
Yep.
6 months out of the year. Well, if that goes to zero,
Yeah.
what is that
Sure.
house worth? But anyway,
Exactly.
but I don't see, but I do see, the national headline is going to scare people. I've had so many people forward me articles about housing prices crashing, and it highlights Austin, and some little pockets of, California, where people are leaving there for short term. And I'm like, well, yeah, but let's look local. The Baltimore DC market, if you kind of group both MSAs together, we didn't get parabolically stupid. Like our growth has actually been muted compared to other areas around the country, but
Right.
I think that's a positive.
Yeah.
I think the froth, right, to your point, right, things go way up and it corrects. I don't think things went way up here. They're more expensive. Like we can't act like things aren't
Sure.
more expensive, but if you take 50 top cities around the country, DC and Baltimore are near the bottom for appreciation over the last decade. So, but still good, but
Yeah.
not stupid like the other ones.
Yeah.
And maybe it truly is just the investor driven concentration that pushed up all those other areas. And our work from home people went from DC to Montgomery County, Northern Virginia, right? They didn't go from California to Colorado.
Yep.
So I think there's a lot of good positives of our market, fortunately.
So you had mentioned when you were 22 and you got in the market, right? And so, hey, I did this, I did this. I mean, what are I assume there's not many people getting the market right now. However, I do think it'd be really interesting, someone young right now, like, hey, this market's really tough, but there is going to be another side of this. What do you recommend someone young thinking about getting in as a lender, as a mortgage, like, what do you recommend they do? I mean, in a market like this, and should they get in it? What's your take on that?
Yeah. It's funny. I just read an article, and it was a mortgage article, and they were obviously we're a very old industry, so I'm like probably one step above the youngest in the industry, right? You and I are like mid 40s, and there's a group of like mid to late 30s, but not
Yep.
many. Not
Gotcha.
many, like way smaller pool than my mid 40s, but then above me is everyone like almost 60.
Yep.
And and it said everyone's trying to figure out how to relate to the younger people. And this one guy said you should just hire younger people to relate to those younger people.
Right.
And I think the problem in the mortgage industry is they don't like hiring people without a book because you're not making any money right now, and that's a legit expense. And trade industries, plumbers and welders and all those people, they have apprentices. So I think anyone young should latch on someone like me, right? It's someone with experience that might have personal capacity issues because of family commitments, and you just learn under that person and support that person for 2 years, and then you can always spin off and be the next great person. I think that's probably the fastest way to growth, but it also takes the right person that's going to teach you. And
Yeah.
the other flaw of our industry, and it might be very similar in real estate, is you go in, you take your test, you get licensed, and then people like smack you on the ass. You're like, all right, go get some business.
Yep.
And like, how, what, when
Yeah.
someone, what do I do? How do I get trade? Like, what's my continuing ed to get real scenarios? And I think that's why so many people fail, is they don't
Yep.
have good people guiding them.
Yeah, I
So
find that to be real. Whether you're a real estate agent, whether you're a loan officer, you gotta follow someone that's done it before, that has those experiences, and you'll learn a lot. And then hopefully the younger community, the younger generation can realize, hey, we're gonna go ahead, I'm gonna have to suffer for a few years, and on the other side, it's worth it. Kind of
yeah,
like being in the military. Hey, if you can suffer for 20 years, hey, that pension doesn't stop, that healthcare doesn't stop. It's an amazing reward if you can think that far ahead, which obviously in our time is hard to do.
very hard to do. Yeah, and when you're older, it's harder to start. So
Yeah.
I'll give you an example. Let's say I'm the smartest loan officer in the universe, but I'm new. I first have to meet people that trust me, and maybe it takes 60 days to earn your trust. And then you finally send me one of your clients, and that client doesn't buy for 4 months because that's maybe a normal buying cycle. Well, you're not even getting your first paycheck for 7 or 8 months. So not many people can just suffer that, especially once life is already established. Young people can do that easily. Go live at home,
Yeah.
right? Rent a room
Yeah.
with a buddy. And while your income or your debts are near zero, take some lumps of personal income and learn, and then be the next great person in the industry.
Yep.
So I think, and our industry is starving for that. So if anyone out there is watching it, I'm always actively looking to hire people for our company that fit that mold. But we need that. Otherwise, our industry, just like the appraisal industry, is way worse than mortgage. Like everyone's old, and no one's getting it.
Yeah.
So
Yeah.
that's another area of stress.
Yeah, so and we kind of talked about frothy markets. Well, hey, we're in the exact opposite of a frothy market. So if you can think far enough ahead, not a bad time to put in some pain and learn right now.
For
Because the
sure.
other end, there will be another end. It's cyclical, right? So
Yeah.
you always give great advice. I love having you on early in the year. There's a lot of people out there thinking, should I buy a house? Should I not? Should I refinance? So for those people, once again, that are interested, a top mortgage lender on Instagram, is that correct?
That's right.
And
Boy,
then
it sounds awful
what was
saying it
the
out loud.
X or Twitter handle?
Advisor John.
Advisor John. I love it. I love it. Any other advice, or what else are you thinking about as you kind of look at the rest of 2024?
It is so for me, it's it's not making any predictions until March,
Hmm.
when we have a few more months to see how the world sort of digests. But I do see there's going to be a lot of opportunity ahead of us. I think people should not just have thoughts in their head and research online. I think if anyone has this thought of buying a home in the next 2 years, it doesn't hurt to have conversation now. And I think if there's one problem that I see, is I think too many people are stuck on the internet or in their house or in their head with a housing conversation and just choosing to tune it out instead of talking a little bit more about their situation, mapping out life. So the maybe final takeaway to everyone out there is it never hurts to have a good conversation with smart people that know the market. And I think there will be a lot of opportunity in DC metro housing for the next decade. But the last year and a half has been a challenge. But there's a rebalancing at play. Over time, people make more money. Over time, interest rates come down a little bit, right? And everything will just kind of balance out. But with our inventory challenges, I think there's a solid floor on housing prices locally, and that should give people confidence to get out there and get active.
John, always a pleasure. I want to point out that you basically had a serious illness this week, and I forced you to jump on this podcast. And on top of that, I was late, and you helped me set up my own lighting. So it's been
Nice.
you've just been amazing today. I appreciate you.
No, I appreciate. I always love hanging out with you guys. You know, I will say just my little allied plug. You know, you mentioned you were the fastest growing kind of independent title company. You know, it's from a mortgage perspective, we deal with the good and bad and ugly of everyone. Like earlier today, I talked about some like bad and ugly real estate behaviors.
Yeah.
You know, what you guys have managed to do from a cost structure, keeping your cost, I think, at an industry lowest side, while also bringing in the fun side of title, but satisfying mortgage back offices, like that is so underappreciated. It's weird for me to have like my teammates that don't even speak to buyers, right? That speak with investor sales or processing stuff. And they're like, oh my God, I love dealing with Allied. They're so always on the ball. I ask them a question, I get an answer right away. And it's not just like someone giving you an answer. It's like Matt Paulson at 7:30 at night giving you a technical answer. So, you know, we applaud you guys for everything that you've done for us. It's certainly made our job a lot easier over the years.
Hey, well, I really appreciate you saying that. And, you know, it's funny because when we look at our title company, there's so many different divides in the sense that I know nothing about title. We have a great marketing team and creative people that are awesome at what they do. But the one thing you cannot skimp on in the service industry are great people in service. And Matt Paulson has kind of led that. We've been very fortunate to get the best processors in the area. And as you know, in this industry, processors are a big part of it. And so thanks so much for saying that. They're going to love hearing that. And, you know, you've done an amazing job of your career. I was introduced to you from a lot of the top producing agents in the area. I've always loved your knowledge. You've been great to work with. And, you know, I would say for people out there that are interested in the industry, whether it's for their own home or getting into it, follow John. He's got some great information. And like I said, I'm going to sit there and watch your long form videos. I'm not scared about it. It's great.
Awesome.
This is great.
All right. I got a lot more coming. I just tricked out my office to try to make it a YouTube channel. So be on the lookout for a lot more to come.
Hey, listen, great seeing you, man. Look forward to 2024. We'll get together in person soon.
Awesome. Thanks, Laddie.
Have a good one.